What if I told you a company just crossed 110 million battery swaps, posted 22.8% year-over-year delivery growth, and is building a 3-brand empire designed to own every single price point on the road, and yet the stock is sitting in full-blown technical meltdown with 0 buy signals across every major oscillator? What if I also told you there is a coiled short squeeze sitting beneath the surface that could turn that meltdown into a vertical move almost overnight, but only if 2 specific product launches and 1 court case break the right way in the next 30 days? Welcome back to Smart Stock Sam. I am your host Sam, and today we are going deep on NIO, the Chinese EV giant that just got slapped with a $600 million fraud lawsuit from one of the most powerful sovereign wealth funds on the planet. Before this video ends, you will know exactly where NIO stands in May 2026, what the institutional money is actually doing behind closed doors, how a potentially legendary short squeeze is quietly building in the background, and the precise price levels that will decide whether this stock breaks out or breaks down for good. The next 30 days could be the most consequential in NIO's entire history, and if you have even $1 riding on this name, you absolutely cannot afford to miss what we are about to unpack. Hit that subscribe button right now and let us get straight into it. Let us start with the raw numbers, because on the surface, NIO looks like a growth machine. In April 2026, NIO delivered 29,356 total units, a 22.8% increase year-over-year. Most legacy automakers would trade entire divisions for that kind of momentum. Their battery swap infrastructure has now crossed 110 million cumulative swaps, a physical, capital-intensive network that competitors simply cannot replicate overnight. So on paper, NIO is winning, and yet the stock sits at $5.85, having pulled back hard from its April high of $7.01. 9 daily sell signals, 0 buy signals, a strong sell rating across the technical board. How does a company growing at 22% end up looking like a sinking ship on the charts? That is the exact question we are here to answer. The journey from $7.01 down to $5.85 was a perfect storm of 3 forces hitting simultaneously. First, mixed data. While the annual numbers looked great, month-over-month deliveries showed a 17.3% sequential decline from March to April. Markets are momentum machines, and when growth stalls sequentially, the algorithms treat it like a warning siren going off in real time. Second, a sector-wide cooldown. The entire Chinese EV space is navigating turbulence right now, with even the mighty BYD reporting delivery softness. When the tide goes out across a whole sector, even the strongest swimmers get pulled back. But the third force is the true gravity dragging on this stock, the legal cloud. The Singapore Government Investment Corporation, known as GIC, has filed a securities fraud lawsuit alleging unlawful revenue recognition of over $600 million. When a sovereign wealth fund with hundreds of billions under management decides to take you to court, the big institutional money does not wait around to see how it plays out. They head for the exits immediately, and that selling pressure is visible in the price action every single day. Now, here is where retail investors get trapped time and time again, what I call the growth paradox. That 22.8% annual growth figure looks incredible on a chart. But ask yourself, what is the comparison baseline? April 2025 had artificially suppressed deliveries because NIO's Firefly sub-brand had barely launched. That easy comparison was priced in by the market months ago. What traders are now focused on is that 17.3% sequential drop month over month. The market is asking one deeply uncomfortable question. Is underlying demand actually drying up? NIO's upcoming product launches are the only credible answer, and they need to arrive fast. NIO's strategic response to that demand question is not one car. It is a 3-tier empire. At the top sits the premium NIO flagship brand, still doing the heaviest lifting at over 19,000 units last month. Below that is ONVO, their family-focused mass market play. At the entry level sits Firefly, targeting first-time EV buyers. 3 brands, 3 distinct buyer profiles, one company trying to own every rung of the pricing ladder simultaneously. But here is what should make you stop and think. This entire pyramid is currently balancing on 2 very specific launches. The ES9 flagship SUV begins deliveries on May 27th. The ONVO L80 launches mid-May. If both vehicles land with lukewarm reception, if reviews disappoint or early deliveries stumble, this pyramid does not gradually wobble, it collapses under its own weight. Could NIO realistically nail 2 simultaneous major launches while managing a 9-figure fraud lawsuit and trying to rebuild institutional confidence? That is the kind of question that keeps analysts awake. Now peel back the car launches for a moment, because the real hidden value in NIO may not be in the showrooms at all. It might be buried in the code and the concrete. During the May Day holiday alone, NIO executed over 1 million battery swaps in a single period. Every swap generates loyalty data. Every swap locks a customer deeper into the NIO ecosystem. That is not just infrastructure. It is a retention engine unlike anything the Western EV market has constructed. On the software side, NIO quietly brought back veteran engineer Qian Wang to lead SkyOS, their full-domain vehicle operating system. This signals a deliberate pivot away from cash-burning startup habits and toward technical discipline and genuine cost control. A software-defined vehicle strategy executed properly can unlock margin potential that pure hardware sales will never reach. NIO is trying to grow up. The question is whether they can do it fast enough to outrun the storm gathering around them. And if you really want to understand where this stock is heading, you have to follow the institutional money, because right now the institutions are not just cautious, they are at open war with each other. On one side, UBS just slashed its NIO stake by 49.7%, not a routine portfolio trim to lock in gains. Their 5th consecutive quarterly reduction. 5 quarters of cutting exposure in a row is not rebalancing. That is a conviction-level retreat. That is a bank saying with its capital that something here is fundamentally broken, and they are not waiting around to find out what. On the other side of the battlefield, Deutsche Bank is aggressively rebuilding its position, adding over 416,000 shares in recent filings. Long-term anchor holders like CVN Holdings and D.E. Shaw continue providing core stability at the base. When 2 globally respected institutions are diametrically opposed on a single stock's fair value, it signals one thing above everything else. A major move is building pressure beneath the surface. The coil is tightening. Someone is going to be spectacularly right, and someone is going to be left holding a position they will regret for a very long time. Why is UBS running? It might have everything to do with what is currently sitting inside a Singapore courtroom. The GIC lawsuit alleges that NIO engaged in unlawful revenue recognition tied to over $600 million in transactions connected to their battery asset operator, Wuhan Weineng, also known as Muratery. The core allegation: NIO was selling batteries to its own affiliated entity to inflate revenue on the balance sheet, making the company appear financially healthier than the underlying reality. This was not an unforeseen accusation either. Grizzly Research raised nearly identical red flags months before the GIC lawsuit was formally filed. For most institutional investors, an allegation of unlawful revenue recognition is not something you monitor from a comfortable distance. It is an automatic sell trigger, regardless of how many vehicles roll off the production line every month. Now let us look at what the charts are actually telling us, because the technical picture right now is about as bearish as it gets short of full capitulation. The RSI 14 is sitting at 42.7. That is classic no man's land. Not oversold enough to trigger a bounce-hunting frenzy from dip buyers, but firmly planted in sell territory where momentum players stay comfortably short. The MACD is sitting at negative 0.048, confirming that downward momentum is accelerating rather than fading. 9 sell signals across major oscillators and 0 buy signals. The Fibonacci pivot point at $5.84.7 is essentially where NIO is clinging for its life right now. Every algorithm, Every quantitative model, every momentum signal in the market is currently programmed to sell every single rally NIO tries to mount. Until something fundamental shifts, buyers are fighting against the tide. The moving average structure makes that battle impossible to ignore. NIO is trading below every single major moving average. The 20-day simple moving average at $5.89, the 50-day at $6 even, and the long-term 200-day simple moving average at $6.27. Classic downtrending structure. Every push upward runs directly into a wall of sellers looking to break even and exit. The single most important level in this entire setup is $6. Until NIO can close above $6 and hold it across multiple sessions, any upward move is suspect. It is a dead cat bounce until proven otherwise by the price data. But here is where the contrarian setup becomes genuinely explosive. And this is the part that could rewrite the entire narrative almost overnight. There are 137.9 million shares currently short on NIO. That gives a days to cover ratio of 6.08. In plain language, if NIO releases a massive delivery beat, a positive earnings surprise, or any meaningful resolution on the lawsuit, causing short sellers to panic and cover simultaneously, it would take more than 6 full trading days of average volume just for those shorts to unwind their positions. 6 full days of forced buying on a stock that already moves violently on normal news. Now pair that with the options market. 87.66% of all options volume is sitting in calls. Retail is overwhelmingly betting on recovery. Wolverine Asset Management recently reduced its put exposure by 16%. Massive open interest is stacked at the $5 support floor below and the $7 resistance ceiling above. NIO is coiled between those two levels like a compressed spring. Could the next catalyst trigger the kind of short squeeze that nobody is currently modeling? The mathematics say it is entirely possible, but only if the fundamental news cooperates and the odds of every variable aligning perfectly at exactly the right moment are exactly what they sound like. So what is the unified picture? NIO right now is a high beta recovery story at a genuine inflection point. Fundamental side, 71% year-to-date delivery growth and a 110 million swap infrastructure moat built over years of capital investment. Technical side, sub-moving average structure, accelerating bearish momentum, and a 9-figure fraud cloud. The late May earnings report is the decider. 2 specific numbers will tell you everything: vehicle gross margin and cash flow stability. If NIO proves it is making money on each car delivered and burning cash responsibly, the fundamentals will eventually drag the price higher against the momentum tide. If they cannot prove those 2 things, no delivery record will save this stock from further deterioration. Here is the disciplined trade setup. The tactical entry zone is $5.50 to $5.80. That is your accumulation window, where risk-reward begins to tilt meaningfully in your favor. If the stock breaks below $5.50, the next meaningful support is the $5 psychological floor, where options interest and retail sentiment converge heavily. On the upside, your confirmation signal is a clean daily close above $6, the 50-day simple moving average. Do not chase this stock on speculation alone. Wait for that close. Once NIO closes above $6 and holds it for 2 or more consecutive sessions, the path opens toward $6.50 and ultimately toward the $7 ceiling. $7 is the final boss, a round number, a zone of heavy call resistance, and the exact level separating a recovery rally from a genuine breakout. If the breakout materializes, the 1 to 3 month target is $6.80, contingent on strong ES9 and ONVO L80 market reception. A sustained breach of $7 opens the 6 to 12 month target of $8 even. But that scenario requires something NIO has only proven once: sustained profitability across multiple consecutive quarters. They delivered it in Q4 2025. The entire bull thesis now rests on proving it was not a one-time performance. The bottom line, NIO has the infrastructure, the brand architecture, and the short squeeze mathematics working in its favor. But it must convert all of that into real margin and restored investor trust, or this story ends very badly. The next 30 days will write the next chapter. Before we close out, I need to be absolutely clear. Everything you heard in this video is strictly for informational and educational purposes only. Nothing in this analysis is financial advice or a recommendation to buy or sell any security. I am not a licensed financial advisor. All investing carries risk, including the potential loss of your entire principal. Always conduct your own due diligence and consult a qualified financial professional before making any investment decision. Past performance is never a guarantee of future results. Now, here is the question I want you to answer in the comments. If NIO clears $6 on strong earnings and the short squeeze begins to ignite, do you think retail buying momentum alone is enough to blow through the $7 ceiling in a single sustained move? Or will the ongoing lawsuit and institutional selling cap that rally before it ever gets close? Drop your honest answer and your price target in the comments below. I read every single one. If this deep dive gave you real value today, please hit the like button right now. It costs you nothing, and it genuinely helps Smart Stock Sam grow and reach more investors every single week. Subscribe and turn on the notification bell so you never miss an analysis drop. And if you truly want to support what we are building here for this community, YouTube has a super thanks feature. Any amount, large or small, goes directly toward keeping this research free and high quality for everyone. Stay sharp, stay disciplined, and as always, invest smart. I will see you in the next one.